The price-to-cash flow ratio, PCF ratio, is a vital financial metric used to assess a company's valuation by comparing its market price to its operating cash flow per share. It is calculated by dividing the market price per share by the cash flow per share. The market price per share represents the current trading price of the stock, while the cash flow per share measures the actual cash generated by the company's operations, divided by the number of outstanding shares. Unlike metrics based on net income, the PCF ratio focuses on cash flow, providing a clearer picture of a company's ability to generate cash and sustain its operations. The key difference between the price-to-cash flow ratio and the price-to-earnings ratio, PE ratio, lies in what they measure. While the PE ratio is based on net income, which includes non-cash items such as depreciation, amortization, and other accounting adjustments, the PCF ratio focuses exclusively on cash flow, which represents the actual cash available to the company. This makes the PCF ratio especially useful for companies with significant non-cash expenses, where the PE ratio might give a distorted view of profitability. For example, in industries like manufacturing or energy, where depreciation can heavily impact earnings, the P/CF ratio offers a more reliable measure of financial health. This ratio is particularly useful for evaluating companies in industries where non-cash expenses like depreciation and amortization can distort profitability metrics. A low P/CF ratio may indicate that a stock is undervalued, making it an attractive opportunity, while a high P/CF ratio might suggest that the stock is overvalued or that investors have strong expectations for future cash flow growth. To interpret this ratio effectively, it is important to compare it to industry averages, historical ratios, and broader market trends. The price-to-cash flow calculator at fairvaluecalculator.com simplifies the calculation process, allowing you to focus on analysis rather than manual computation. By entering the market price per share, which you can find on financial platforms like Yahoo Finance, and the cash flow per share, which is available in a company's cash flow statement or financial reports, you can instantly determine the P/CF ratio. This makes the tool especially valuable for investors seeking quick insights into a stock's valuation. Using the P/CF ratio is essential for identifying financially sound companies with consistent cash flow generation. During periods of market uncertainty, companies with strong cash flow often represent stable investment opportunities. By regularly analyzing the PCF ratios of companies and utilizing tools like the Fairvalue Calculator, investors can make well-informed decisions, spot undervalued stocks, and build a solid foundation for long-term investment success.